Today, we're revisiting an investor and Real Wealth member from episode 835. We're going to catch up on his investment journey, and then I'm going to spend some time coaching him on how he should proceed with his portfolio. I'm Kathy Fetke, and welcome to the Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fetke, the real estate investor's resource.
In episode 835 of The Real Wealth Show, we heard from Ben and Sophie, two investors who cut a 30-year cash flow goal down to 15 years through real estate. They utilized out-of-state investing to make that dream possible. Ben is now considering how he should consolidate or change his real estate portfolio after an increase in vacancy and rental property turn costs that decreased his cash flow. In this episode, we'll hear more where Ben's portfolio is now, and then I'll coach him on how to proceed and make changes to hopefully still retire early. Ben, welcome back to the Real Wealth Show.
Hi, Kathy. Thank you.
You did such an amazing interview last time, and we wanted to bring you back to see how things have gone since then. But for those who maybe haven't heard the first show you were on, can you just recap how you achieved financial independence so early?
Sure. So my wife, Sophia, and I, or Sophie, we got married in 2013 and we bought our first house. At that time, I felt like I achieved most of the things I wanted to in life, but I really wanted more time. So I made a financial model, and the model said I was going to work for 20 plus years and retire in 2036. And, through saving and living below our means and investing in real estate, almost all of it through Real Wealth, we achieved our original objective in 2022. So that was less than half the time that we originally forecasted, and we now have a property portfolio of over 40 doors in 5 states. So that was 2022.
Unbelievable. Now, how does that compare with the last time you were on the show?
I mean, so we've actually been on twice. So I think the first time we had just kind of reached that goal and we were like, where are we going to go? We were like, well, we want to keep on grow maybe another 30%. Our family has grown. We have aging parents. And then we did another show. And I think that was when the market was starting to turn, maybe around 2020, 2022 and 23. And the question is, where do we go here? And a lot of what we were doing was repositioning our portfolio. We were selling off some houses in Detroit and moving those doors, 1031 exchanging them to Cincinnati or Alabama. But what's happened in the time since we spoke is not at all what I expected. We're like, hey, we got here so fast and we just need to grow another 30%. And things shifted around the market. And what's happened in the past 2 years has actually been the profitability of our portfolio has actually declined by about a third over the past two years. And I think I can attribute it to 2 reasons. One is our maintenance and vacancy costs have increased substantially, more than doubled per property. And I think the other thing that's happened in the past year is the rental market has softened, particularly in Florida, where we are heavily concentrated. So now, and I would love your help on this. Now I'm kind of at a crossroads because I realize, I've looked at what we have and I realize what we do need some restructuring. What we're doing is not entirely working for us, and we need to make some changes, not only to get back to where we are, but then growing in profitability again.
It's so important to always look at your portfolio at least once a year and see if it's still performing or if certain properties are performing less than they used to. So, and I know that you've been doing that over the years and things have certainly changed. Looking at what got you here, would you say that the properties that are now not as performing as well have performed in other ways? In other words, did they experience a lot of appreciation during the last years?
I think there's a little bit of both. What got us here, we have a mixture, easily half between the cash flow markets that Cincinnati, Alabama was Detroit, and then the growth markets, the Florida and Houston. And what we found is as our portfolios aged, we've kind of fallen into this position where we have a lot of doors at $150,000 houses or so, well below the median home price in the United States, which is now what, 450,000. And what we found is our portfolio has aged, and as maintenance costs have increased, the cost of everything, the cost of paint, the cost of lumber, is those lower cost houses have become incredibly expensive to maintain. And I found that per door, our $150,000 houses are actually costing more to maintain than our three or $400,000 houses. And we have a lot of them. And that's where I'm like, well, I think we should have fewer doors, possibly in higher quality markets where the rental yield is slightly lower, but I anticipate whether it's the demographics or the property manager or the market, that hopefully our maintenance costs could be, and even the quality of the property could be lower per door, and hopefully grow our cash flows back again.
Are you currently living off the cash flow now?
No.
No. So
Yeah.
is this what is the purpose of your real estate portfolio today?
It's meant to give us this job optionality. And where
Mhm.
we were 2 years ago, I was like, oh, maybe if I work another 3 or 4 years, we'll be completely job optional. And now, that profitability has gone down. So we live off, a portion of our incomes, right? And we continue to save aggressively. And then our real estate income, we've plowed it back into investments. And that's one of the questions I have now. It's less profitable than it used to be, much less, but it's still profitable. And I question about, okay, where should we be investing our savings and real estate income moving forward, given
Mhm.
where we are.
Got it. Okay. This is the most important question that so many of us forget, and that is kind of like, what are we doing this for? What is our ultimate strategy? Are we looking to retire today and live off the cash flow, or are we looking at 5 years in the future, 10 years in the future? And the decisions we make will be different depending on what the answer is. So I think what I'm hearing you say is that you're not necessarily needing the cash flow today. Are you both working still?
Yes, yes. And I was absolutely, who knows what. When we spoke 2 years ago, I was thinking I might work until 2025, 2026. And now I've had this realization that's not going to happen. We have to restructure our portfolio and it'll be a few more years. But our intention is it's definitely to create a cash flow stream that makes us 100% job optional. Or we would scale back our work, maybe not work altogether, but scale back and work part time. So I think the decisions we're making are 100% based on creating a reliable cash flow stream that could cover our living expenses in, let's call it 3 or so years. It's not doing so right now. But the fact that absolutely our end goal is to create that end cash flow stream, that leads us to much different decisions than if we were on a 10-year time frame, for example. We might be investing in more leveraged properties or something like that. We're absolutely investing for a stable cash flow, building a stable cash flow over the next 3 to 5 years.
So you said you had a goal for 2025, 2026. That's changed due to a lot of things changing in the market. What is your date now? Or is that what we're going to figure out today?
I mean, I would like it to be, maybe another year or two past. So there's not a firm goal that I have to hit this date. I think I still want to hit that number. That it might, let's call it 30% above my original number. And I don't have a strict time frame for it. I guess one thing I've learned, I'm sure all of us have through all the uncertainties, it's really about the journey, not the destination. So, I have this goal of reaching this number, but I'm going to, enjoy my life and structure my life to have meaning and enjoy my time with my family and my work for that matter, my
Mhm.
full-time work in the meantime.
I love that. I've often said to people, retire from the things you don't like to do, but keep doing the things you do like to do. It's like really honoring the unique ability that you have in your professional work And then it doesn't feel like you're working. It's like you're retired, but also making money.
Yeah, absolutely. And as I've, realized that my work might be longer than I thought, I have concentrated on the things I like doing. And now, who knows what? Maybe
Yeah.
I'll continue working.
So I'm curious, I do want to talk about what's next for you, but I'm also curious for those listening, what you might have done differently, kind of knowing what you know now that you maybe didn't know when you first started out. Is there any different path you would have taken, different properties you would have bought, or you would have done exactly what you did? And it's important to remember that timing was different then, right? It was a different world, different market. Interest rates were low. You were looking to be job optional by 2025. So yeah, looking back, what might you have done differently?
I mean, I think what I've realized, and I've even mentioned that this before, is for our scale and then the income we needed to produce to sustain our lifestyle, I probably would have moved up the chain earlier, faster, from the $150,000 houses to the three to $500,000 build to rents, and then now even maybe 800 to 1,000 to a million duplexes in A markets, and where we are now is we have a lot of inexpensive doors. So you like say you're going around the monopoly board and the properties get more and more expensive as you go around. We are heavily concentrated at the lower end. So I think, and I guess that's a natural journey that every investor goes through. So
Hmm.
every investor I've spoken to has gone through that journey,
Yes.
and we did it just at a lot of scale. Um,
Mm.
40 plus stores. And the way I think about it now is if I restructured my portfolio, I might have, I don't know, 20 doors or who knows what, even less, maybe at a higher price point, not just because of the cash flows, but just also in terms of what it takes for me to manage it and to really manage it and be on top of it and do a good job of making sure I'm getting the most out of each of our properties.
You nailed it. I mean, I think it's partly Robert Kiyosaki's fault. I say that, gently. Just this whole idea of cash flow, cash flow, cash flow. And yet, some of these markets, I'm sure you've experienced, I have too. You bought a house for $150,000 and today it's still worth $150,000, maybe a little more. Have you
Right.
seen any appreciation in those areas?
I mean, the Detroit houses that we got out of, those kind of ended up
Lost.
the same way. We bought them for $65,000. They might have been worth 190 to 100 on paper, but they had so much deferred maintenance that I ended up selling them for $65,000. The properties I'm looking to get out of now, I'm probably up about a third on average. So that's good. I don't know how much of that I'm going to have to give back when I sell them because it's not the best time. And what I would like to do, it's almost the opposite of what you read about in your book or what we first did. Instead of selling a house in California and buying 7 houses in Cincinnati or Alabama, what I actually want to do this time is possibly sell, anywhere from 5 to 10 houses in Alabama at the same time, ideally to an institutional investor, so I could have one point of time to 1031 exchange them into a bigger, better property in Tampa or something like that. So I think I'm going to have to give back a big piece of that margin. I don't know how much.
I think what so many of us have learned over the years is that when you're looking, and I should just ask you this, if you were, if anyone was coming to you saying, hey, I'm thinking about buying an older home because it's less expensive, the cash flow seems high, what would you want somebody to be aware of in terms of the maintenance costs?
I guess this is one lesson is I always model the maintenance cost as a percentage of rent, right? So let's say it's
Hmm.
10% of rent. So you think if it's a 10,000 renting for $1,000 a month, it's $100 a month. And if it's renting for $2,000 a month, it's $200. And the truth is maintenance costs are almost fixed. Let's say you turn over the property in 2 to 3 years, you pay a certain amount to turn over that property. And it doesn't matter if the property is renting for 100, 1,000, 2,000, or 3,000. And in fact, that turnover cost might be higher for the lower cost properties. because the
Right.
tenants are harder or whatnot.
It's
Um,
older. It's usually an older
it's
property.
older, yeah.
Yeah.
I mean, that said, if you're just starting out, that's probably where you have to go, just to get started, and you move your way up. But when we first started out, we were selling homes in California, and we had, $500,000 to invest. And with that kind of equity, in retrospect, I probably would have invested in, bigger properties. 500,000, you put 25% down, you can get a $2 million property. Now, maybe I would have been afraid to do so at that time, but I'm just saying that, I didn't have to start all the way at the bottom of the chain given the equity that we had from the sale of our houses in California.
Yeah. Yeah. Those are just such important lessons. If you have a home in California or in a high priced market that you would like to get access to that equity and put it to work, you can, and you don't need the cash flow today. I'm thinking about someone who was at our live event just this last weekend, and she's got a $3 million property in the San Francisco Bay Area that she wants to sell in 1031. These are real situations of people saying, it's time for me to retire. I've made all this money. Now what?
Mm-hmm.
And for that person, I'm not saying not to buy in Ohio or Detroit. I'm saying you need to recognize that there's going to be higher expenses on older properties. That's just how it is, and factor that in. And is it worth it? Would it be better to be in a newer property where there maybe would be less maintenance, especially if the idea is to be job optional? You don't want your job to be constantly dealing with properties,
Exactly.
right?
Yeah, and I
All
think
right.
there's a middle ground. I mean, having one $3 million property is one thing. Having 30, $100,000 properties is another thing. And looking for that middle ground for you in terms of the quality of tenant you want and the cash flows, and then understanding now that some of the lower cost properties might look good on paper, but 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 might not actually cash flow you want. And I thought I was, to be fair, at the time I thought I was finding that middle ground, buying a $150,000 property instead of a 65. But now I found my middle ground has moved, and I'd rather be, you name it, closer to the median price of a home in the United States per door, closer to the $300,000 to $500,000 per door rather than that, $150,000 door. So I think you have to find what's the right middle ground for you, given your risk tolerance, how much the amount of equity you have to divvy up over your properties as well.
Yeah, absolutely. If you only have $50,000 to invest, your decision is going to be different than, like you said, if you have 500,000.
Yeah, and our
You
equity has grown quite a bit, since
yeah.
we've invested in real estate. So now we have much more equity to play with, and now I realize I need to reallocate that.
So describe to me your perfect real estate portfolio in 2 to 3 years if everything
Well,
went
that
well.
I don't know, Kathy. That's where I thought, you know, I just made it up, go from 20 to 40 doors. And then if you did the math there, then the cost per door would be doubling. So then maybe that would be going from, I don't know, 150 to $200,000 to doors to three to $400,000 door. I don't know exactly where that is yet. You always make the best incremental decision with the information you have. So I'm figuring that out. And it was a few years ago. I don't think right now the answer for me is some of the build to rent options. I do like small multifamily, um, but I have one unit that's in downtown Tampa in an A neighborhood. It's a triplex. I got it for $800,000. And the nice thing about being in a downtown area, I've learned, is it's hybrid. I have one unit rented in medium-term rental that I find the tenants on Furnish Finder, and then I have two long-term tenants. And that property has had almost zero maintenance in the time I've owned it. So I'm like, well, maybe I should get another one of those. Um, but it's like, when you have information, you can only test it. Like, I don't know if I would turn over my whole portfolio. I know that maybe I want to get another one of those and see if that continues to be the right answer. I mean, Florida also, has its softness. There are people exiting Florida right now, but I feel like maybe that's an opportunity for me to reposition there, since since, I don't think it's going away as in the long term demographically as a place people are going to move.
Right. Yeah. Looking at the long term, the U-Haul comes out with a report every year, and it's still on the list as one of the places where people are moving. North Carolina was on that list too.
That said, Kathy, I'm open to your suggestions. I only know what I know, so I'm like, okay, this is working well. Maybe I should do more of that. But I'm totally open to for once I'm actually, open and, not quite sure how to move forward, which is why this call is exciting to do right now.
Yeah, well, what we've noticed is that the medium term rental, which is around 30 days for people who aren't familiar with that, it's a furnished rental that would be it's not short term, so not
Hmm.
just 2 to 3 nights, but people who maybe want to stay for a month or two, like traveling nurses. We've seen that be very lucrative, really increase the cash flow, and of course, the short term rentals additionally can be super high cash flow if they're well located, but they obviously take more work. So, yeah, depending on what you're trying to do, short term rentals can give you enormous tax breaks as well. So, something to think about and maybe look into. But based on what you know already, and I know you know a lot, more than me probably at this point, if you were to choose a market today, out of the ones that you've already looked into, which one would make sense?
I mean, so I'm a little bit different, I would say, than your average investors, because for me, I am absolutely trying to simplify. So I'm mostly inclined, unless there's a really good reason to focus, like, I think we have 5 or 6 property managers at this point, mostly inclined to take the ones that I have and double down on the ones that are doing best. So for me, that's where I said, okay, I will double down on my Tampa portfolio.
Hmm.
Now, if there's your average investor and they're starting fresh, amongst the, 20 or so markets that Real Wealth covers, that's a whole different question,
Hmm.
for me, I've realized I really want to focus my relationships and simplify. So it's a little bit different answer.
No, no, it's great. I love that answer and it's so recommended to look at your properties every year, determine which ones are performing the best and do more of that because you know as an insider, right?
Yeah,
And then sell the ones that are underperforming or just doing okay. That's what makes us so lucky in real estate is we have these options. You have more options the more you get in the game, right? You don't have as many options. Like you said, you have more options today than you did when you started because you have more equity.
absolutely. Yeah.
Yeah, so Tampa would be one. What else?
I mean, I think there's always the option of which we did with our Detroit portfolio, and actually we just are just exchanging our last 2 doors from Detroit to Cincinnati.
Hmm.
And I've said this many times. Those Cincinnati portfolios are um, and they are cash flow properties, are continuing to perform for us. But in the long run, I feel like a lot of my wife's portfolio, her portfolio is concentrated in Cincinnati, and it's good to also have a growth market. So I would say those are the two where I would double down. Our other Florida properties outside of Tampa, I'd kind of call them a watch, and I'm also considering swapping out a property manager there too, which is always painful. If you've had to do that before, and
Hmm.
in the spirit of me better managing my existing portfolio, I might actually fracture my portfolio properties instead of having one property manager covering all Florida. Actually, market by market, finding a a specific portfolio property manager for that market who comes recommended.
I mean, that sounds like a really balanced portfolio to be in the Northeast and the Southeast. You're spreading it out. You probably still own in the Bay Area, I'm guessing.
Yeah,
So,
yep, our primary, no
yeah,
rentals. Yep.
yeah. So, I've said this before, but one of if you're at all concerned about climate change, this is a great plan too because the Northeast, and specifically by the Great Lakes, is considered to be the least at risk from climate change. And if we're really talking about a long-term portfolio, I mean, this is what you're talking about, is something that's going to support you and your family for years to come. So we can't look at today or tomorrow or next year. We have to look at, I'm assuming you want these properties to support you for 10, 20, 30 years. I mean, you're young, right? You
Yeah.
have a lot of life ahead of you. So where, obviously you could make changes in the future too, but this is the biggest mistake people make, is thinking today instead of in the future, and how these are going to support you. So given that is not a overnight play. This is, your next move is probably a good 10 years, right? Does it still make sense what you're saying, kind of growing your portfolio in the Tampa area and then also in Ohio?
Yeah, I think that makes sense for me. Probably the scary move that I'm facing now, which is, try to package and sell, 5 or 10 Alabama properties to an institutional investor so you could buy a really nice property in a good market in a good neighborhood in Florida. So that's going to be a new experience for me, and frankly, it's not the best climate to do it. But when we sold our Detroit property, we did it one by one as the properties as they vacated. And it's like when you're selling a $60,000 property, you could put equity in and get 150, but you don't move that far up the chain. So for me, it's like, well, let's make a big shift. Instead of settling off the 150 one by one over the next 2 years, try to do it all at once and put it into something bigger. And I'm going to clearly give up a little bit, right? I'm going to have to give up some margin there, but then, hopefully that would move me more quickly into the future state. So that's one of the, I've never done that before. So that's one of the big decisions, or experiences that I'll have over the next year.
Yeah, I mean, a great place to look there would be just speaking with local property managers, because they're in touch with usually investors looking to buy.
Yeah.
And also Roofstock is one that markets to institutional investors this kind of product. And I'm not so sure that it's a terrible time to sell, because you're selling at a price point that is so desperately needed in America. Affordable housing is the number one issue. And so it may not be as hard as you might think, because there's more and more investors looking to buy in these more affordable markets. Just always talking to your local team, right? Whether it's the team you've been working with or whoever is well known in that market for selling. It may or may not be your property manager or the buyer's agent, because maybe they're just good at buying and
Yeah.
finding the deals, but really making sure that you have a team that this is what they do. They work with investors, they sell properties, or they can help you sell properties, would be the next step, because again, that price point is pretty rare, and it's so desperately needed today.
Let me ask you, if you were looking to invest around, I don't know, 800,000 to $1 million, and we could keep it to the real wealth markets, and if I unconstrained it from where I already am, where do you think I should tell someone to
I'm still crazy about the Texas markets. I love kind of anything Dallas, not Dallas specific, but in the region.
Hmm.
That area is not slowing down for growth.
Yeah.
Love San Antonio market. So, we have got a build to rent community that we're building there, because it's the number one fastest growing suburb. Let's see, in top 10 zip code, fastest growing zip code in the country. So I'm still that girl who wants to get in front of the growth. I bought in enough flat markets to know that the expenses can be extremely high. And if you don't have your property appreciating, you're not going to come out ahead.
Yeah.
I've just seen it too many times. There's just too many expenses with older properties that, if your property's worth 150,000 today, it might be worth 150,000 in 10 years. Whereas buying a newer type property in an area poised for growth, where you're seeing that population growth, you're seeing the job growth massively, and you get in front of that in a good quality property that's, again, newer, it's just less work, in my opinion.
Yeah.
That's what I would do. So I'd be looking around the Dallas area, I'd be looking around San Antonio, maybe Austin, We don't have a team there, but if you're talking big bucks, that's an area that's a little bit oversupplied. So you might be able to negotiate some deals. And then I still like Florida, more inland. I mean, our St. Petersburg properties are doing fine, and the insurance rate has not even gone up. I don't know what's happening. Everybody complains about it. Older home insurance hasn't gone up. Our properties in Palm Bay, again, have done well. Took a little bit longer to rent this time around, but it was during the election time, and I just think everybody was freaking out. So insurance rates are really low there, and property tax as well. So again, I just like to follow the demographics. We're seeing on that U-Haul study, the Carolinas came out on top, and that is kind of rare. So there are some people who want to move out of the colder northeast, but aren't, fans of Florida. Maybe it's too hot for them. So the next choice is the Carolinas, and there's a lot of growth there. So I might look at our team there. You're going to be paying more. It's a higher cost market, but it's one growing very quickly.
I have another question for you, actually. Besides repositioning my existing equity, as I'm continuing to work, we are continuing to save. And I've realized that I definitely don't want to be growing our portfolio in number of doors. So then, and, I mentioned, we're working towards a cash flow number in the next 3 to 5 years, not a long-term equity play. So then, I ask myself, well, what do I do with our savings? Do I pay down debt? Do I continue to push it into our real estate portfolio, which I do every time I 1031 exchange and buy a more expensive property? Or do I, put it in other asset classes, even grow our stock portfolio and given our goals? And, I haven't really come up with a good answer to that. And I've done a little bit of all three. Some debt snowballing, 1031 exchanging, putting more money, and then also investing more heavily in the stock market. But I don't know, I guess, given where we are, I question, I want to do it optimally, right? And I don't want to throw good money after bad. So, I'd love to, what do you think?
Yeah, I mean, I just did a presentation at RealWealth on this topic: stocks, gold, bonds, real estate. What do you choose? Obviously, if you pick the right stock, you're going to be probably doing really well, outperforming everything. I missed out on Nvidia. Tesla. We were in Tesla, but we didn't get in early. You can obviously pick the right stock and do incredibly. We are starting 4 years of a new administration that's all about growth, also all about real estate. So I don't know that you can really go wrong if you go with an index fund over the next 4 years. Probably going to do all right. Still, with that said, if you watch my presentation online, realwealthshow.com, just go to, recent webinars. And the first part of it, I talk about that. The biggest difference between real estate and any other investment is leverage. You can take you put 20% down, but you get appreciation on the whole thing, on 100%.
Right.
So 20,000, I'm using easy numbers, but $20,000 down on $100,000 property, but you get appreciation on the whole 100,000. So there's really nothing that compares. And then you add the tax breaks. If you were to perhaps get one short-term rental, or at least have a property that you put on a short-term rental for a period of time, when that 100% bonus depreciation comes back, our most recent one was like $150,000 deduction in 1 year.
Wow.
And that's a massive tax savings. So I just don't think personally anything compares to real estate. With that said, of course you should, diversify. Of course you should have some money in the stock market, some money in gold, just to have that and to have something a little bit more liquid. But if you're able to 1031 and avoid taxes and be able to just kind of upgrade your portfolio, do that.
Yeah.
In my opinion. So lots of exciting choices. Maybe it's the time to get back on one of our tours or get back out there and see what's going on. But, we're talking about the beginning of a 4-year boom cycle.
That'll be good. And I'm sure you have a lot of investors who are looking forward to that after the last couple of years. So to have some mixed experiences.
Yeah. Just, we've got a president who's kind of into real estate, right? So I think there's going to be a lot of benefits. Yeah. All right. Any last comments or questions?
No, well, thank you again, Kathy, for what you do, and obviously, you and your team and the teams that you're affiliated with have helped our families get to where what they are. So, thank you so much for what you do. I really appreciate it.
Thank you. Thank you so much. I really appreciate that. We appreciate you. And it's just been such a wonderful thing to watch your journey and have you share it with our listeners so they can learn from your experience. Nothing beats it. Nothing beats that, right? Hands-on
All right.
experience. So thank you for joining me here on The Real Wealth Show and sharing your wisdom.
Thanks, Kathy.
Thank you for joining me here on The Real Wealth Show. If you'd like to get a referral to one of the teams in the areas I talked about, just go to realwealthshow.com, click on the Invest tab. You will have to join first, but it's free to join. And then you'll get a referral to our fantastic teams in Dallas, San Antonio, and Florida. I'm Kathy Fettke. Thanks for joining me here on The Real Wealth Show. We'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.